Well, most hard economic data showing the U.S. economy, it's been holding steady, a signal that's at odds with how Americans may be actually feeling. University of Michigan consumer sentiment hitting the second lowest level on record in May, even as inflation continues to cool and the unemployment rate hovers near a historic low. Joining us now to dive into that disconnect, Meredith Whitney Advisory Group's CEO. Meredith, great to have you here. In a recent note, you wrote that over half of U.S. households are barely holding on, and yet at the same time we have the employment data holding up, the so-called hard data holding up. To what extent do you think that there could be a risk out there that is similar to that 2008 housing market crash that you predicted?
I don't think there's a risk of there's clearly no risk of a housing market crash. Consumer households or households are as unlevered as they've been in 40 years. So leverage is the lowest it's been in 40 years. But I think if you dig down into how consumers and households are really doing, over 50% of households have already been through their first recession. That was 2 years ago. And I think they're going into their second recession in 3 years. So 52% plus of households are living paycheck to paycheck. And they've really been squeezed by the cumulative inflation of higher food prices, higher insurance costs, higher costs across the board. And when you look at these households, a great number of these households are employed in the sectors that have been under the most pressure. So clearly, aggregate spending has slowed, definitely in travel, leisure, and hospitality, and in retail. And I think that's where you're going to see pressure in terms of job losses. But I think you'll also see pressure in general from a clear, these households have no wiggle room in terms of inflation. And I see inflation across the board. So let's talk about what Walmart said last week, which was that they try to maintain prices on grocery, but they'd put increased prices in other areas of the market. I think grocery prices are going to go up again. So one thing that has not been discussed broadly at all is immigration and ICE raids. And recently, a private equity company said that they see cracks in the economy because workers are not showing up at work for fear of ICE raids. So there have been ICE raids across the board at areas, workplace areas. And when employees don't show up to work, revenues suffer because in the instance of quick service restaurants, there's no one to man the kitchens. So I think you're going to see revenue pressure in those areas. They'll cut jobs just to maintain profitability, and then you're seeing more consumers squeezed.
And Meredith, you just laid out so many great points in terms of risks to the consumer. I have here existing inflationary problems, the fact that people have already undergone several recessions across U.S. households, tariff risks related to pricing for consumers, and then, of course, immigration. One thing that is top of mind for me, and you note, is that the wealth effect could be making it look like the hard data is better than it actually is, because the richest consumers can make it look like the economy is doing okay as long as they keep spending. To what extent is that potentially at risk, given the downward pressure that we've seen in the stock market, and how that could potentially lead to a pullback in spending amongst the wealthiest individuals?
Madison, it's a great point because the aggregate, the hard data is so skewed by the high end. So the high end controls over 2/3 of all spending, and so you get a difference between an American Express consumer that has lots of discretionary spend, and you would think the economy is doing great, but for small businesses, and then you look at a Capital One or a Bread Financial, and consumer spend has materially slowed. And you can see it in part in the credit card data. Balances aren't really growing very fast. So in the fourth quarter and the first quarter, balances of home equity loans grew faster than credit card loans. So in many cases, the low end and some of the medium end are maxed out, and so they're drawing on the equity in their homes to either pay down debt or get a breath of liquidity where they really need it. And one thing that you didn't ask me about is, the older consumers are really stretched. So the seniors are really stretched. So a lot of times people think the boomers, or oftentimes people think the boomers are the richest generation, but that's skewed to a smaller portion of that generation, and seniors are taking on so much more debt, which is counterintuitive because the older you get, the more conservative balance sheet you want to have. And so you can see, if you look closely, you can see real cracks in the economy at the household level, but you just have to slice the data differently than how the aggregate, the typical data points that most economists look at.
Right, and the data points that the Federal Reserve looks at. And it makes me wonder, Meredith, is the Fed at risk of missing a potential slowdown that could lead us to yet another recession because they're not necessarily looking at all of these different data points that you mentioned?
Well, I think the Fed's in an incredibly difficult situation because you're going to have inflation, which has not shown up in the hard data yet, and you're going to have real stress at the economy. So a slower economy, a more stretched consumer, higher unemployment, but inflation. So it goes, as Jay Powell had said, whichever diverges the most, either employment or inflation, they'll attack the fastest. But I think inflation is going to diverge faster than employment. So they're going to be in a tough position to deal with both. And I think rates will go down slower than the economy otherwise, all else equal, would justify.
And to that end, I want to wrap our conversation with a look at the housing market and the impact of that Moody's downgrade on U.S. credit, concerns of the deficit, lifting the longer end of the yield curve higher. We had the 30-year above 5% on Monday. To what degree does the deficit risk impact home buyers, given how that impacts the activity that we see in the bond market?
Well, affordability has been very difficult for new home buyers because you haven't seen, with rising rates, you haven't seen a commensurate drop in home prices. So you have higher rates and high home prices, which makes affordability really, really difficult. I think that a couple things will happen, are happening. You've had Rocket Mortgage said in its first quarter earnings that what happened in April, they have not seen since just after the great financial crisis in 2009, where you saw a confluence of high rates, volatility, and double-digit declines in mortgage applications. I mean, that's terrifying. So you have a really bad first part of this the spring housing season, the strongest spring is the strongest part of the home season. 50% of home sales happen in this, over 50% of home sales happen in the spring. And I don't think it's improved much. So I think this is going to be a problematic year for housing. So affordability is one thing. And then the other issue is over 60% of homes are owned by households over 60, and they're tapping into home equity, which means they're not going to be pressured to sell. So you're in this frozen home market, and I think that's problematic. Now, one point I'm going to raise about that: the National Association of Realtors estimates that 18% of the GDP comes from the housing market. So that's going to put the fact that the housing market has been so weak this spring is going to put even more pressure on GDP.
Meredith, great overview as always. Really appreciate you making time for us this morning.
Thanks, Madison.